Let's take a broad look at the markets. Our guest is Andrew Slimmon, Managing Director and Senior Portfolio Manager at Morgan Stanley Investment Management. Thank you very much indeed for joining us, Andrew.
My pleasure.
You think for once analysts may be too pessimistic about companies' profit forecasts? You think that after Q2 earnings, people will be raising their estimates?
I do, primarily because if you look at the first quarter earnings numbers, the overall, there were beats. And if all else had been equal, which it's not, but if all else had been equal, the numbers for the full year should have gone up. But because of tariffs, companies withdrew their guidance and left to their own devices. Wall Street cut numbers for the full year, expecting tariffs were going to take a big bite out of business. And as we come into second quarter earnings, that has not been the case yet. So there's a big gap between existing business and expectations. And I think that's one of the reasons why the market has rallied here is because the realization that the numbers were brought down too low. The last time this happened, Andrew, was during COVID. Companies withdrew guidance. Wall Street cut the numbers and then basically played catch up the rest of the year. As it turns out, their guidance was, their numbers were too low.
However, you do say that there are indications the market is stretched and at risk of a correction.
Yeah, I think so. I think that second quarter earnings, we're seeing it. It will be pretty good. Now, you know, some of these companies have already rallied going into second quarter, but I think second quarter will be good. But then we, you know, kind of get to this gaping hole of news flow that happened starting end of July until really mid-September. And that's seasonally, you know, it is historically not a great time for stocks. And boy, oh boy, I mean, we've just had a 25% rally. Basically, the more risk you took, the better you've done in the market. The most speculative stocks have outperformed most. So we're going into a dicey period when the market's been ripping, and you know, that gets me a little anxious.
You think tariffs will not be the cause of a correction, and that people sold in April and they turned out, well, that's wrong. I guess partly because the White House backtracked on a lot of its threats.
Well, that's true. You know, what we learned by the White House is tariffs are, you know, tariffs are important to the White House, but the economy is more important, so they backed off. But the stock market doesn't react to the same news exactly the same. And I think as it pertains to tariffs, if you saw a reinitiation, and we're starting to see that already, the market's going, I already got burned by overreacting. I'm not going to do it again. So it's always the unknown that the market reacts to. And I think one of the mistakes investors make is they try to figure out what it will be. And I'll say, hey, let's not figure out what it will be. Let's figure out whether the market is vulnerable to surprises. And I think the market, given this rally, given what has led, which is the risk on, the market is vulnerable to a surprise.
One group you say that has been neglected by investors and is due for a rally are the defensives. What kind of stocks do you mean by that? Sure.
Well, you know, very simply, as I said, if I'd ranked, you know, all the stocks based on their beta, which is how much risk they have, if all you did in early April is just said, I'm just going to buy the riskiest stocks I can find. I mean, I think consensus would think you were crazy, but the truth is that's worked great. And what has been left behind are some of the very low risk companies that do well, whether there's, you know, recession or no recession, like Staples, insurance companies, discount retailers, waste haulers. Those stocks have really done nothing. And so if you get a surprise out of the blue, I think people go, oh gosh, these stocks have really lagged, and they're safer, and I think they'll come back into that. I might be a week or two early, but I suspect that will be an opportunity because, boy, oh boy, they've been left behind.
One name that you like is Costco. Would you call that a defensive stock? I guess some people will go there every couple of weeks, no matter what happens.
No matter what, Andrew, no matter what. That's exactly right. I think, you know, that stock, same price it was in early May. It hasn't really, you know, their business is, so their business is fine. So I think you want to find companies that are doing well, but just been left behind. So this is a low beta defensive stock that if in fact there is some type of concern, let's just say, maybe we get a slowdown, the economy suddenly shows a little weakening or something like that, they'll run back into these types of names.
I have to ask you something. We know that the traders did extremely well in the latest quarter on Wall Street. Have you seen guys and gals going around the office flashing new Rolexes? Are the traders boasting?
Well, you saw some of these firms report very good numbers, and that's because of, the traders. Now, I sit on the investment side, and I think, unfortunately, a lot of people got too bearish in April, and that turned out to be raised cash and so forth, and that turned out to be a mistake. Now, we went the other way in terms of our fund, so we added financials, added some industrials into the low, primarily because I have always kind of stuck with this concept that it's only the third year off the low of fourth quarter 2022. And in the third quarter, it tends to be a positive year. It's just not as good as the first 2 years. So when the market was down a lot, it allowed us to add to risk. And all I'm saying now is, well, the market's up a lot, and I'm not sure this is a year you want to chase returns, and you really want to tack against it. So right now, I just don't think it's the time to take on risk. But certainly traders took advantage of the panic that we saw earlier this spring.